It's February 2024 and then Lunar New Year. What can we expect in the New York real estate market in the Year of the Dragon, which is a zodiac sign associated with prosperity? I'm going to share my predictions on the residential sales and leasing markets and the commercial sales and leasing markets, particularly the commercial office market, based on observations and data, not the zodiac. Even a broken analog clock is right twice per day, so I think I can do better than that. I'm not going to cite specific studies or data for the most part. Instead, I'm going to speak in generalities based on my aggregate review of studies and my experience representing commercial landlords, developers, co-op and condo boards, and working with property management companies and also handling a high volume of sales and lease transactions. So let's start with an analysis of the economy, and then we'll turn to the real estate markets. No one really knows what's going to happen to the economy and the real estate markets in 2024, but generally there are two camps or schools of thought: soft landing camp and the recession camp. My real estate predictions are going to be presented under both these scenarios. As you probably know, the Federal Reserve System, often referred to as the Fed, is the central bank of the United States. It was created by Congress in 1913 to provide the United States a stable monetary and financial system. The Fed is run by a seven-member board of governors who are nominated by the president and confirmed by the Senate to serve 14-year staggered terms. You're probably familiar with the chairperson and spokesperson of the Fed, Jerome H. Powell, who is serving his second term as chairperson, which ends May 15th, 2026. Congress has given the Fed the dual mandate of maintaining moderate long-term interest rates while simultaneously maximizing employment and keeping stable prices by keeping inflation at about 2%. During the COVID pandemic, the Fed and the U.S. government did a good job maximizing employment at the expense of allowing inflation to increase dramatically. You may recall that during the height of the pandemic, many people were working from home, having their families drive them crazy, or if you went into the office, the roads were empty and the trains were pretty empty. And during this time of the pandemic, the U.S. government issued stimulus checks and there were supply chain shortages in the production of consumer goods. And they were not able to keep pace, which resulted in inflation, right? This price inflation. In addition, the Fed kept interest rates low, so banks could borrow funds from the Fed at a lower rate, and in turn, those banks could lend money out at lower rates, which resulted in a loan and refinance boom, and further stimulated parts of the economy and resulted in more inflation. So fast forward to 23, 24, the Fed has been trying to lower inflation by increasing the Fed funds rate, which has been increased 11 times since March 2022, which generally has the effect of slowing down inflation and economic growth generally. So far, the rate increases seem to be lowering inflation, but even despite all the rate increases, the U.S. economy employment data have remained strong, and the stock market just hit an all-time high. This would seem to indicate that we are headed towards a soft landing and not a recession as a result of the Fed rate increases. And it is predicted that the Fed will actually start lowering the Fed rate in May 2024. So we're going to have a soft landing, right? That sounds great, but not so fast. There's a lag between when the Fed increases the Fed funds rate and when it impacts the economy. And the economy might not have fully been impacted by the Fed rate increases yet. Historically, it takes about 8 months to 1 year from the last Fed increase for the economy to feel its full effect. So it is possible that we could be facing an economic downturn or recession in the spring or summer of 2024, or even sometime in 2025. My prediction is that there will be a downturn in the economy because that's inevitable due to its cyclical nature. I do not know when this will occur, but let's look at the real estate markets and how they could be affected. So the residential sales market, according to the Case-Shiller Home Price Index, nationwide home prices are approximately 45% higher than they were pre-pandemic. And there's been a lack of supply in the market. And there's also been, well, this is actually due to, the interest rate increases, right? During COVID, when interest rates were so low, 90% of residential mortgages were obtained at a rate below 5%. So these owners are not selling. However, with interest rates projected to decrease in May 2024, there should be an increase in supply in the spring. However, I think even with the increased supply, I don't think the market's going to be flooded with inventory. So I don't think that prices are going to drop. I think that actually probably maybe a 1% price increase in 2024 overall under a soft landing scenario. However, You have to keep in mind that if you're buying or selling residential real estate, you have to keep an eye on a potential recession or hard landing scenario. The real estate prices and market generally lag the stock market by approximately 6 months. So if there's a major downturn in the stock market, you should plan accordingly. I'll keep my analysis of the predictions for the residential rental market short and simple. New York City rents went down during COVID, and outside the city, they went up. But people have returned to the city now, and New York City rents are above the pre-COVID rates. And there's been an ongoing housing shortage in New York City, so particularly for affordable housing. So I think there's going to continue to be, modest rent increases in 2024. If we enter a recession in 2024, then you can expect rents to fall. The commercial sales market. So 2023 was a dismal year for the commercial sales market. I think it's going to remain slow in 2024 until the Fed lowers rates, hopefully in May 2024. And according to a report by Ariel Property Advisors in 2023, Manhattan investment property market experienced a 45% drop from 2022, which is the lowest in the past decade, excluding 2020, with sales of only 11.1 billion. More specifically, the Manhattan office market saw a 58% year-over-year decline in dollar volume to 2.87 billion, with the average price per square foot falling 22% to $848. Sluggish 2023 performance will likely carry over into 2024 due to higher interest rates, rising expenses, potential expansion of rent regulation, and pessimism about a potential recession. In either the soft landing or recession scenario, lower interest rates coming in later in 2024 are going to cause an increase in investment sales volume. And hopefully prices have already hit their low, but I do not expect there'll be much price increase until investors sees what happens with the economy. The commercial real estate market I'm going to talk about, and with a particular focus on Manhattan. And if this topic is of interest to you, you should sign up for our newsletter or check our website during the coming weeks, as I'm interviewing some very knowledgeable real estate brokers who are going to analyze the leasing market, provide firsthand stories in a lot more detail. But let's flash back for a moment to the years leading up to the pandemic, which I would consider a healthy leasing market, when the vacancy rate was only 7 to 8% in Manhattan. If you were a landlord, you had lots of prospective tenants looking at spaces. And if you were a tenant, you had to negotiate hard, but you could obtain an economically reasonable rent and a good tenant improvement credit on a new lease. You'd be eager to renew if you were paying a fair market value and you liked your space. Today, there's a very different leasing market in Manhattan and the surrounding office market. New leasing transactions in 2023 were about half of what they were pre-pandemic, but this is much better than the almost non-existent leasing market during the pandemic and at its peak. The vacancy rate in Manhattan is currently approximately 20%, which is about double what it was pre-pandemic. And the average asking rent is currently approximately $74, according to a recent report by Colliers. This is not far off the pre-pandemic rents in the highs 70s to 80s. The issue here is for landlords is that there are fewer tenants in the market now, and they're taking smaller spaces and seeking shorter terms like 5 years instead of 10. So whether there is a soft landing or recession, it appears that the commercial leasing market has already hit its current bottom. Therefore, I expect in 2024, the leasing volume and asking rents to increase or remain stable, with the absorption rate of less desirable or vacant space being repurposed over a long time horizon. So in sum, interest rates in the economy are going to dictate sale prices and volume and rents in 24 in both the residential and commercial markets. But I think it's going to be even more than usual because I think we're at an inflection point, and there's going to be some changes. It really depends on whether there is a soft landing or a recession. Thank you for tuning in, and remember to make every day great.